Hi guys, and welcome back to the channel where it's all about honest and transparent advice to help you in this tough old world we're living in. So I'm Alex, and in this video we're learning the ABCs of investing. I'm stripping back the stock market, cracking the NASDAQ code and deciphering the S&P 500. We're even going to be globetrotting to markets around the world. So buckle up and let's get on with it. Now before we start throwing around terms like bulls, bears and blockchain, remember, this is not financial advice. So with that out of the way, let's define what investing really is. So investing is allocating money or resources with the expectation of generating income or profit. An investment is like a seed. Nurture it well, give it time, and it will grow into a money tree. So it is thought that roughly 20% of the world's population are investing in stocks in one way or another. So first off, let's try and understand what stocks are. So stocks are basically tiny pieces of a company that you own. So when you buy a company stock, you're buying a piece of their future profits. Now there are two types: common stocks that give you voting rights in the company and pay dividends, and preferred stocks which don't give voting rights but offer a higher claim on profits and assets. It's like choosing between being the king or the treasurer. So these stocks are bought and sold on the various stock markets around the world. Now, the stock market is a public market for trading stocks and derivatives. So in simpler words, it's like a superstore where you buy and sell pieces of companies. Now, the New York Stock Exchange and the London Stock Exchange are some of the biggest fashion runways for these stocks. Next up, we have the NASDAQ, which stands for National Association of Securities Dealers Automated Quotations. Hell of a mouthful. So it's the tech titans playground, home to big players like Apple, Amazon and Google. Now the S&P 500 is like the who's who of the stock market. It's an index comprising 500 of the largest US publicly traded companies. As of 2023, the S&P 500 represented approximately 80% of the US market's value. So yeah, it's a big deal. Then we have the markets around the world and emerging markets. Beyond the American shores, there are other significant markets such as the London Stock Exchange, Japan's Tokyo Stock Exchange, with companies like Nintendo, Panasonic and Sony, so I just had to get Nintendo in there, and Hong Kong's Hang Seng. Emerging markets like India, Brazil and South Africa are gaining traction too. Now, while these markets can offer attractive returns, they do carry higher risk due to political and economic instability. So, how do we buy stocks? Well, there are multiple ways to buy them. You can go through a brokerage, a financial advisor or robo-advisors. Now around 61% of Americans buy stocks through a brokerage. eToro, Trading212, Capital.com and Vanguard are a few popular ones to name a few. So it's like online shopping but basically for stocks. Now please don't forget to hit that notification bell if you're finding this video helpful, and check out my other videos for similar content. Now let's be honest about the benefits and dangers of investing. Now, do you remember Uncle Ben's famous words in the film Spider-Man? With great power comes great responsibility. So investing is just that, it's powerful. Stocks have provided an average annual return of around 10% since 1926, but it's also fraught with danger. There's always the risk of losing the money you invest, and studies show that around 80% of investors lose money in the stock market. Now, this is because most people don't understand how the stock market works. As a result, they make bad decisions based on recommendations from people who don't know what they're doing. Subsequently, invest in the wrong companies and then nearly always sell their stocks at the wrong time. Now, this often happens due to poor timing and not holding on to stocks for the long term. Now, remember, as I've said in previous videos, it's about time in the market, not timing the market. Buying and trying to sell quick is a surefire way to lose your money. Now, I'm sure you heard the famous saying by Warren Buffett: be greedy when people are fearful, and fearful when others are greedy. Meaning, when you typically follow the herd and do what everyone else is doing, when they're doing it, you will more than likely overpay. On the other hand, when things to the masses are bad and they lose interest, basically you are buying on sale, so fill your boots. Now, the same can be said for anything similar, including the recent housing market and cryptocurrencies. And also, let's be honest, how many of you softy dads watching recently, like me, spent insane money on a bottle of Prime just to please your kid, which now the demand has worn off, is back to normal prices in the supermarket? Yeah, it hurts. So, same principle, guys. So how do people know which companies to invest in? Well, researching stocks is a crucial part of the investment process. A well-researched investment decision can make the difference between a profitable return and a potential massive loss. So stock analysis typically falls into two broad categories: qualitative and quantitative analysis. Qualitative analysis involves evaluating intangible and unquantifiable factors that might affect a company's performance. Now, these include management. The competence of a company's management team can heavily influence its success. Factors like the executive's experience, their track record, and their strategy for the company are crucial to consider. Brand strength. A strong brand can give a company a competitive edge. It's often linked to customer loyalty, can help a company maintain or increase its market share. Industry position, where the company stands in relation to its competitors, matters. Companies that lead their industries often have competitive advantages that can lead to higher profitability. And regulatory environment. Now, this is the potential of impact of government regulations on a company's operations that can also affect its performance. Then we have quantitative analysis. Now, this involves crunching numbers and looking at quantifiable data. Now, this can include financial statements. These documents include the balance sheet, income statement, and cash flow statement, give a comprehensive view of a company's financial health. Financial ratios. These provide quick insights into a company's performance. So key ratios could include the price earnings ratio, debt equity ratio, and return on equity. Then there's market capitalization. This is the total market value of a company's outstanding shares of stock. It gives you an idea of the company's size relative to its competitors. Revenue, and earnings growth. Now, growing revenue and earnings can be a good sign that a company is in a strong financial position. So in conclusion, both qualitative and quantitative analysis are essential in evaluating a stock. Using both can give you a more holistic view of a company's situation and its potential for future growth. And that's our crash course for investing today, guys. Now, remember, it isn't a get-rich-quick scheme, but with patience and diligence, it's a proven way to grow your wealth. Now, I'll be back soon taking a look at the UK housing market with tips on buying a home to help you get ahead. Until then, keep learning, keep growing, make sensible decisions. Take care, and I'll see you very soon.